Okay folks, welcome back. This is the price action model number 5 day trading trade plan, and it focuses on 40 to 50 pips per trade. Okay, ICT price action model number 5 day trade plan, 40 to 50 pips per trade. Again, I warned you that we would see a lot of these slides throughout each model and trade plan. We move through preparation, opportunity discovery, trade planning, trade execution, and trade management. So if you have not watched the model 5 content, the presentation, and then there's a supplementary lesson that I added on for that model, watch both of those before you go into this. Otherwise, it's not going to mean much to you at all. And again, these trade plans rely heavily on the notion that you have taken copious notes throughout the core content, that you have studied the individual price action models and the supplementary lessons for those that have been provided thus far. Okay, so preparation. We're going to note all medium and high impact events for the markets that you're following, and you're going to study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Okay, we're going to determine the IPTA data range of the last 20 days. Now, this is the only IPTA data range that you have to be concerned about. We don't count Sundays. So we're going to be noting the highest high and the lowest low in the past 20 trading days. And this is going to be your current dealing range. So 20 days ago, that's where our focus is. Again, inside that range, whether we're bullish or bearish, we have to determine what the highest high and the lowest low is. Inside this dealing range, we will look for the next draw on liquidity. Where is price likely to trade to next? Above a previous day's high or below a previous day's low. Minimum of 40 pips. Remember, this model focuses on the low end of 40 pips to an average of 50 pips per trade. Now, you can get more as we get into the other slides that talk about that, but I want you to focus primarily on this range, if you will. And we will look for a PD array in the direction of the weekly range bias. We anticipate price to move to a PD array that would support our weekly bias on a day and economic event found on the economic calendar with the current or next trading week. This is what we wait for. This will be a run on the basis of a low resistance liquidity run. Opportunity discovery. We're going to identify the previous day low or an intra-week low when the bias is bearish. We're going to identify the previous day high or an intra-week high when the bias is bullish. We're going to expect a daily range expansion in the direction of this bias. Trade planning. When the market is primed, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely unfold. We will short premium fair value gap and buy discount fair value gap setups. When we are bearish, we will frame a short entry when the price has moved up into a 15-minute premium fair value gap PD array that converges with a standard deviation of no more than 3 standard deviations during London Open or New York Open. We can implement scalping protocols on this stage as well for further reduction in risk. Now, when I'm talking about this 3 standard deviations, you're going to go through model number 5 because I actually give you the breakdown on what to use, whether you use the central bank dealers range, the Asian range, or flout. So again, go back to that model and watch the videos and study it, and that way you'll know what we're referring to here specifically. When we are bullish, we will frame a long entry when the price has moved down into a 15-minute discount fair value gap PD array that converges with a standard deviation of no more than -3 standard deviations during London Open or New York Open. Again, much in the same way we said in the previous slide, you can implement scalping protocols on this stage as well for further reduction in risk. And for those that aren't really sure what that means, the models that we used for like 5-minute charts and 1-minute charts, you can use that in here to make your risk smaller. When we are bearish, we will target the sell side liquidity below the previous day's low or an intra-week low inside the 20-day IPTA data range. The next logical discount array at 40 pips will be the initial objective. There will likely be multiple old, daily, or intra-week lows inside the IPTA data range, but we will use the one that frames the potential of at least 40 to 50 pips. When we are bullish, we will target the buy-side liquidity above the previous day's high or intra-week high inside the 20-day IPTA data range. The next logical premium array at 40 pips will be the initial objective. There will likely be multiple old daily or intra-week highs inside the IPTA data range, but we will use the one that frames the potential of at least 40 to 50 pips. Trade executions. When we are bullish, we will note the European Open price on Tuesday and filter all longs at or below this price level, which overlap in the 15-minute discount fair value gap. We will anticipate a 5-minute chart institutional order flow entry drill trade entry to form inside of a retracement lower during London Open and or New York Open kill zones or a sell stop raid. Now, this information, all you're going to do is think the same way for Wednesday and Thursday. Now, the model itself is really designed to take this trade on any particular day. On this trade plan, I'm filtering out Mondays and I'm filtering out Fridays. So it allows us to give us an opportunity for trading on Tuesday, Wednesday, and or Thursday. Now, Thursday, for your notes, that day is a wild card. If you have a large range day on Tuesday and a large range day on Wednesday that worked out in your favor, don't take the trade on Thursday because you're most likely going to get some kind of consolidation or retracement. If you have a small range but win on Tuesday and a large range on Wednesday, then you can take the trade on Thursday because it probably has a little bit more room to trade. So that's kind of like the only caveat for this particular trade plan. When we are bearish, we will note the European opening price on Tuesday and filter all shorts at or above this price level, which overlap in the 15-minute premium fair value gap. We will anticipate a 5-minute chart institutional order flow entry drill trade entry to form inside of a retracement higher during London Open and or New York Open kill zones or a buy stop raid. Short trade management. When we are entering a short, we will place a sell limit order on all positions we will execute with our demo account. We will use the standard deviations and PD array convergence minus 5 pips as our entry price when using the sell limit order. If multiple orders are used, all use the same entry price in the sell limit orders. When we are entering a short, we will place a limit order to take 40 pips as our objective on one position. We will place a second limit order to take 50 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture a 50 pip objective, close 80% of the trade and see if it has any more room to run. Now that's assuming that you have a third order active. So in other words, the assumption in this slide is you have 3 working orders. The first one takes profit at 40 pips. The next one takes 50 pips, and a third, if you get 50 pips, that third order has to have 80% of it closed at 50 pips, and then let that act as a leader to see if you can get any kind of more pronounced run in that particular market. When we are entering a short, we will note the premium array and standard deviation convergence we aim to enter at. We will place our stop loss above this high plus 15 pips. We will re-enter if the trade stops out. We can monitor it for a secondary entry. Day trades may require multiple attempts to secure a solid entry. Do not fear this. Long trade management. When we are entering along, we will place a buy limit order on all positions we will execute with our demo account. We will use the standard deviation and PD array conversions plus 5 pips as our entry price when using the buy limit order. If multiple orders are used, all use the same entry price in the buy limit order. When we are entering along, we will place a limit order to take 40 pips as our initial objective on one position. We will place a second limit order to take 50 pips as our second objective. We will use multiple orders to manage the trade idea. If you capture a 50 pip objective, close 80% of the trade and see if it has any more room to run. When we are entering along, we will note the discount array and standard deviation conversions we aim to enter at. Now, think about what I'm stating here. Okay, I've used this slide in previous models, but the assumption again is you've gone through all the trade models. So model number 5 gives you the specifics in terms of what those standard deviation convergences are and how they overlap. Okay, so again, it's important you go back and watch that particular price action model. We will place our stop loss below this low minus 15 pips. We will re-enter if the trade stops out. We can monitor it for a secondary entry. Day trades may require multiple attempts to secure a solid entry. Do not fear this. Stop loss management. This is always the same for me in any kind of trade. So when we are in profit 25% of our expected objective, stop loss can be reduced by 25%. When we are in profit 50% of our expected objective, stop loss can be reduced by 50%. Now that means you're in half of your expected profit and you still have a negative stop loss. You're not rushing to get break even. You're not trying to get it to plus. You're not strangling the position. You're not worried about it. You're focusing on whether the trade continues in your direction. When the position is at 75% of the expected profit objective, stop must be at break even at that point. All right, money management. These slides are the same on every model. Again, like I said in the previous trade plan, I'm not going to go through actually reading out everything. It's all here, but I include it for completeness sake, and that way you can use it. You can change all the numbers here and do the math as I outlined in each slide, so that way you can get your respective inputs. But I like to say this one all the time. This was one that needs to be reminded of multiple times. If your demo account takes a loss on a trade and it is the full R% that you assumed, in other words, the risk that you were assuming for that trade, if it's a complete washout, you get stopped out at your maximum, you're going to drop the R% by 50%. And when the loss is recovered by 50%, and like if you lost $100, if you make $50 back, then you're permitted to return back to the maximum R% per trade. So it's not requiring you to go, if I lose 100, I got to make 100 before I can go back to trading the same size. If you know what you're doing with these models and the core content and you're very disciplined, you only need to get back 50% of what you took as a loss, then start working towards trimming back that drawdown. If the reduced R% trade assumes a loss, reduce the R% by 50% until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%, you are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not a jagged roller coaster with deep declines. Start backtesting. Collect multiple sample sets with this trade plan. If you're unclear about some of the process, rewatch the lessons for this price action model. I will provide sample sets, but do not rely or wait on mine. Dig into your charts and study what has been provided here. Now, at the time of these recordings, this is June 1st of 2020, and I was applying supplementary lessons to the models, but because of the present pandemic at the time of this recording, first couple months of this year, we've had COVID-19 affect a lot of the businesses and the resources that I use to manage this mentorship. And when we get out of COVID-19 issues, okay, and I can have the support agency that works with me in terms of monitoring the abuse of people sharing my content, then I'll go back to adding more supplementary lessons. But I'm staying on task with giving you the trade plans, but the supplementary lessons and in the algorithmic content that goes along with each, that will not be until we get out of the woods, if you will, and the company that is employed by me to do all of the tracking and location of the accounts that abuse my content. Right now they're working on a very, very low skeleton crew, much like every other company out there, and they can't accommodate this mentorship level. We have a lot of people here, and it's a lot of work for them to go through and find all this stuff. So when that is resolved, then I'll start including again the supplementary lessons. So if you're wondering where they have been, it's only because I haven't been able to work with the company to do what they're hired on by me to do, which is help me find those individuals that are sharing or abusing the content. And once they're discovered and removed from the mentorship, then we'll resume in regular business. So hopefully you found this insightful. Until next time, I wish you good luck and good trade.